My promise to you. By the end of this chapter, we'll know the remaining 8 candlesticks that actually matter. We'll know what they mean and how we can spot them to make even smarter trades. This is no fluff. This is just what works. If you and I have never met before, hi, I'm Caro Trading. I made it my goal to learn how to trade successfully by using a very specific trading strategy. The strategy being called volume price analysis. And I'm here bringing you along for the ride. I'm not here to sound smart and I'm not here to throw big words around. All I'm here to do is to simplify things for you exactly how I wish someone would have done it for me when I started trading myself. So if you ever felt like trading was something out of reach, stick around. You might surprise yourself. And as always, don't believe anything I say. Verify it. We're going to continue expanding our candlestick knowledge by delving into a very peculiar world, the world of dojis. So what exactly do we mean when we say doji? Well, doji is nothing more than a fancy term for a specific type of candlestick where the opening and the closing price are either exactly the same or almost the same. It doesn't always have to be exactly the same. And this translates into a very basic doji core rule, how I like to call it. The rule being that it's then a candlestick that has a body that is very small, where the opening and the closing price is not exactly the same but almost the same, or when the body is literally a horizontal line. This is when the opening and the closing price are exactly the same. We now know that a narrow body like that can appear in many different ways. So you have the very compressed body, so the rectangle is very thin, it's not literally a line, and then you have candlesticks that have a body where the body is a line. Doji is just an umbrella term referring to candlesticks with a very small body. And it turns out that there are 4 major types of doji candlesticks that you're gonna see on and on your charts. It doesn't matter on which time frame you're on and which instrument you're trading. From my own experience, these are the 4 main doji types that I kept seeing over again. And once I understood them, everything became much more clear. This is candlestick number 9 because in the previous chapter, we dissected the first 8 candlesticks, but this would be the first doji. And we're going to start with the classic doji. So how do we visually recognize this candlestick on our charts? The doji is a candlestick where the opening and the closing price are either exactly the same or almost the same. So the body is either a line, which is when the opening and the closing are exactly the same, or a very narrow rectangle when they are not the same. And in this specific example, the body is literally a line, meaning that the opening and the closing price are the same. As for the classic doji, both the upper and the lower wicks are short. Not long, but short. And the body is also near the center. It doesn't have to be exactly in the middle. It has to be more or less in the center, which means that the wicks are balanced. So it's not like the upper wick is much longer than the lower wick or vice versa. And the very important thing to remember is that the body does not have to be exactly in the middle for this to be considered a classic doji. So let's say, for example, that you see this specific candlestick that you see in the example, but the body is a little bit in the top half. Still near the center, but not exactly in the center. It can still be considered a classic doji, so this is not an exact science. And it looks like a tiny cross on our charts. What happened exactly during the move? We know that the buyers and the sellers stepped in, undoing each other's work. Now, what do I mean by this? Let's say, for example, that the price opened. We know that the buyer stepped in, bringing the price up. But we also know that the price didn't stay at these higher levels, meaning the seller stepped in, undoing the buyer's work, and even regained way more control, causing the price to get below the opening price. But then the seller stepped in again, causing the price to increase to get back to its opening price. So this is what I mean when I say that both stepped in and both undid each other's work. Because the opening and the closing price are exactly the same, at the end of the day, neither the buyers nor the sellers ended up clearly winning the fight. And as with the other candlesticks that we saw, we can only see what really happened inside of this candlestick by dissecting it on the faster time frames. Meaning that if you, for example, see this candlestick on the 4-hour time frame, I highly advise you to go to the 1-hour time frame, to the 30-minute time frame, or even the 15-minute time frame to see exactly how was this candlestick formed. So how do we interpret this classic doji candlestick? We know that buyers and sellers both tried, but neither won. Meaning that buyers didn't have enough strength to keep the price up, but also sellers didn't have enough strength to keep the price down. So at the end of the day, no clear winners. Meaning that there is no clear sentiment in either direction. It's not that the buyers are clearly winning, and it's not that the sellers are clearly winning. So if I were to ask you, would this be considered a sign of strength or a sign of weakness? What would you answer and why? Well, for the classic doji, since neither side is clearly winning, this is actually considered a sign of indecision. Because again, we don't know who has the upper hand. And what this means about what is likely to happen with the price next is we don't know. This is the reason why you're often going to hear the advice from many other traders that whenever you see a doji candlestick, wait until the next candles develop, because the next candles are going to give you more information about which sentiment the market is taking. Is it going to take a bullish sentiment, which means that we would then go long, or is it going to take a bearish sentiment, which means that we would go short, we would sell? We wouldn't buy here. Candlestick number 10, which is the second doji candlestick on our list, the long-legged doji. What are the visual characteristics of this puppy? The opening and the closing price are either exactly the same or almost the same. And this is how it was with the classic doji candlestick as well, where the body is either a line or a very narrow rectangle. Again, same logic. But the difference with the long-legged doji is that instead of having short upper and lower wicks, it has very long upper wicks and very long lower wicks. So both wicks are long. And the body is also near the center. It doesn't have to be exactly in the center, more or less in the center. The wicks are more or less balanced because the body is in the center. So it's not like it has a very tiny upper wick and a humongous lower wick. And again, the important note here is that the body doesn't have to be exactly in the center for this to be considered a valid long-legged doji. So if you see this candlestick, for example, in this example, the body is not exactly in the center. It's a little bit in the upper half, but it's still considered a long-legged doji. And it looks like an elongated cross on the charts. So let's see what happened during the move. We know that during the move, the buyers and the sellers stepped in, undoing each other's work. Check. We already understood the logic from this statement with the classic doji candlestick. The end result is that neither side ended up clearly winning. And why do I say that? Because the closing is either the same as the opening price or almost the same. So when you look at the final score, opening versus closing price, pretty much nothing happened. And pay attention how these two statements were both the exact same conclusions that we drew with the classic doji candlestick. Now, some of you may be asking, okay, Caro, then if it's the same conclusion, what is the difference between the classic doji and the long-legged doji? Let's look at the difference between the classic and the long-legged doji. The classic doji is going to be on the left, the long-legged doji is going to be on the right. First, we're going to look at the similarities of these two candlesticks over here. First of all, both have upper wicks and lower wicks. So both have vertical lines that stick upwards from the body and downwards from the body. Both candlesticks also have a narrow body. Translated, opening and the closing price are either exactly the same or almost the same. And both have a body that is near the center. Again, it doesn't have to be dead in the center. More or less in the center is fine. So what are the differences? Well, in the classic doji, the wicks are short, whereas in the long-legged doji, the wicks are long. And what this means is that for the classic doji, the price then didn't move much from the opening price. That's why the wicks are short. The price did fluctuate and it did distance itself from the opening price, but not a lot for long wicks to be created. How is the case with the long-legged doji, where since the wicks are long, the price did move a lot from the opening point. For the classic doji, this then means that there was a fight, but it was a tiny fight, again, because the price was fluctuating, but it was staying pretty close to the opening price. Whereas for the long-legged doji, there was an even bigger fight. And this then translates to that the classic doji is a sign of indecision, but it's a small sign of indecision. So imagine a tug of war with one side is pulling, bringing the rope to the left, and the other side is then pulling, bringing the rope to the right, but there's not a lot of action going on, so the indecision is small. Whereas for the long-legged doji, you have the exact same tug of war. Instead, the rope goes all the way to the left, and then it goes all the way to the right. The fight is much bigger, and therefore the indecision is much bigger. And this is the key difference between the classic doji and the long-legged doji. The classic doji signals small indecision, whereas the long-legged doji signals pretty strong indecision. The other thing that they have in common is that since they're both a sign of indecision, the best piece of advice that you're gonna hear around is whenever you see these on your charts, wait until the next candles develop, because we don't know what the market sentiment is going to be. We don't have, by only looking at the price, any other clear signals that are telling us that it's going to be bullish sentiment next or bearish sentiment. So the best thing is patience. This is why traders say trading is a game of patience. Patience really does pay off. So wait for the next candles to develop, analyze the charts once again, and then you can take your trade. Now, why should I care if there is a small indecision or strong indecision? That's also a very interesting question. And the answer is because when buyers and sellers fight, tension builds up. And that tension is extremely important for us as traders. Let me explain and try to follow the logic here. The bigger the fight between buyers and sellers, the more tension is building up between buyers and sellers, which means that once one side finally wins, more pressure gets released. Now, what I mean by this is, let's say, for example, that this tiny hair elastic is the tug of war. The more tension builds up, in other words, the more the buyers are pulling and the more the sellers are pulling, the more tension is in this elastic band, which means that when one side finally lets go, this thing is gonna fly a much bigger distance compared to if both are pulling. Nothing's happening here. But if I were to do this, boom, that thing just flew. And this is what I mean with the statement over here. Once one side finally wins, more pressure gets released, meaning that the eventual breakout is going to be a lot stronger. In other words, the trend that is going to follow, which is either an uptrend or a downtrend, is going to be a lot stronger for us. And this translates that we then have much stronger trading opportunities for us. And this is what we want as traders. We can only make money when the price goes up or when the price goes down. When the markets go sideways, if the price were to stay at the exact same level, you're not going to make any profits. This is why it's important for us to know what type of tension is building. Now, how does this translate to the classic doji and the long-legged doji example? We know that the long-legged doji is stronger in decision than the classic doji because the long-legged doji has longer wicks compared to the classic doji, meaning that the long-legged doji has more tension being built up than the classic doji. Remember the elastic, meaning that the long-legged doji then might release more pressure than the classic doji once side finally wins. And I say the word might because trading is all about probabilities. There's no certainty in trading. It's all about probabilities. And this then translates that the long-legged doji might have a stronger breakout than the classic doji, meaning that for us as traders, the long-legged doji might have stronger trading opportunities than the classic doji. And this is why we should care whether there is small indecision or strong indecision, because it gives us an indication about the sort of trading opportunities that are awaiting us as traders. Going back to the long-legged doji itself, how do we interpret it? We know that both the buyers and the sellers tried, but neither side ended up winning. So the buyers didn't have enough strength to hold the price up, but also the sellers didn't have enough strength to keep the price down. So at the end of the day, neither side ended up winning, even though there was a strong fight going on, much stronger compared to the classic doji. In other words, there is no clear sentiment in either direction, even though there is increased tension being built up. So if I were to ask you, is this a sign of strength or a sign of weakness, given that there is no clear sentiment in either direction? And I'm pretty much giving you the answer over here. This is also a sign of indecision. And what this means about what is likely to happen with the price next is we don't know. Therefore, the piece of advice is wait until the next candles develop, until they start printing on your charts, so you can get more information about whether the market is going to take a bullish sentiment or a bearish sentiment. Candlestick number 11, which would be the third candlestick on our list, the Dragonfly Doji. How do we visually recognize it on our charts? The Dragonfly Doji has an opening and a closing price that they're either exactly the same or almost the same. Again, that's the standard pattern that you're going to see for the Doji candlesticks, where the body, once again, is either a line or a very skinny compressed rectangle. In this specific instance, the lower wick is much longer than the upper wick. So the wicks are not equally long. So in other words, the wicks are not equally balanced as was the case with the classic doji and the long-legged doji. And some people say that preferably you'd have no upper wick at all, but a little bit of an upper wick is totally fine. And the body in this instance is not near the center, but near the top. And some people say that the body has to be exactly the top. But again, if you have a tiny upper wick and the body is not exactly at the top, it's totally fine. It can still be considered a dragonfly candlestick. So once again, the wicks are not balanced and it looks like a dragonfly on our charts. So let's see what happened during the move. We know that the buyer stepped in a little bit, pushing the price up, but then the seller stepped in hard, undoing the buyer's work, and the sellers even gained way more control than they regained. And this is what started the formation of the long lower wick. So the sellers brought the price all the way down. But we know that the price didn't stay down like that forever. So we know that the buyers then stepped in really hard, undoing most of the seller's work and bringing the price back up near the opening price. As with any doji candlestick, neither side fully dominated the fight when you look at the final score. So when you compare the opening and the closing price, they're pretty much the same. But in this specific instance, the buyers did show strength at the end because that's how the lower wick got created. The sellers pushed the price all the way down and then the buyers recovered. And this is very important when it comes to the interpretation of the Dragonfly candlestick. And once again, as with all the other candles, we can only see what really happened inside of this specific candlestick by dissecting it on the faster timeframes. So please get comfortable going to the faster timeframes and analyzing the price movement for the making of a candlestick that you see on the slower timeframes. How do we interpret the Dragonfly doji? The key lies in the wick. This is super duper important. Let me explain. This is the Dragonfly that we just looked at, and we're going to analyze what happened during the formation of the lower wick. We know that for the creation of the lower wick, the price had to go all the way down. In other words, the sellers were stronger than the buyers. That is what caused the price to go down. So there was bearish sentiment. Now we also know that the price didn't stay at these lower levels forever. We know that the buyers had to step in and they had to overpower the sellers. Buyers were at some point stronger than the sellers, causing the price to go up. In other words, there was bullish sentiment. Notice how we have an instance where there was a strong sentiment switch from bearish to bullish, where the final sentiment is bullish. This is super important. Final sentiment is bullish, meaning that the sellers failed to sustain the lower prices. This is the important story that the lower wick tells us. The sellers failed and the final sentiment is bullish. So if I were to ask you, even though this candlestick is red, would this be considered a sign of strength or a sign of weakness, and why? Since the final sentiment is bullish, this is a sign of strength because the lower wick is clearly telling us loud and clear who failed. The sellers failed. Try to not get fooled by the color. Try to not conclude that, hey, because this candlestick is red, then immediately it's a sign of weakness. No. Never mind the color. If necessary, change the colors of your candlesticks on your charts to neutral colors, to purple and orange, to black and white, anything that you like. The important thing is that you read the wicks. The wick tells the story. So what do this means about what is likely to happen with the price next? Well, since this is a sign of strength, it is very likely that the price is going to go up. I say very likely, and I give this 2 out of 3 arrows when it comes to the probability of the price going up, because again, there's no certainty in trading. It doesn't mean that 100% of the times that you see a Dragonfly doji candlestick that the price is going to shoot up. There are multiple factors that we need to take into consideration. So overall, it is a sign of strength, and it is very likely that the price is going to start rising. Candlestick number 12, which would be the 4th doji candlestick on our list, the Gravestone doji. How do we visually recognize it on our charts? The Gravestone doji is a candlestick with the opening and the closing price that are either exactly the same or almost the same. Same old pattern with the dojis, meaning that the body is either a line or a very thin rectangle. And in this specific instance, the body, so in this example, is literally a line, where the upper wick is much longer than the lower wick. So it's the exact opposite as what we saw with the Dragonfly doji candlestick. And some people say that preferably it has no lower wick at all, but a tiny lower wick is totally fine. And the body is near the bottom. It doesn't have to be exactly at the bottom. In this specific example, the body is near the bottom and it can still be considered a Gravestone doji candlestick. In other words, the wicks are not balanced and it looks like a gravestone on our charts. What happened during the move? We know that during the move, the sellers stepped in a little bit, pushing the price down a bit. But then the buyers stepped in really hard, undoing the seller's work, and the buyers even gained way more control. And this is what caused the price to go all the way up. But then we know that the price didn't stay there forever. We know that the sellers stepped in hard again, undoing most of the buyer's work and bringing the price back down near the opening price. So when you compare the opening and the closing price, we know that neither side clearly won the fight when you look at the final score. The key here is that the seller showed strength at the end. We can only see the details of this fight by zooming in on the faster time frames. Just like with the Dragonfly doji candlestick, the key lies in the wick. It's not about the color, it's about the wick. This is the gravestone we were just looking at, and it's a green candlestick, and we're going to focus on how the upper wick was made. We know that for the creation of the upper wick, the price had to go all the way up. So the buyers were stronger than the sellers, causing the price to go up. There was bullish sentiment. Now we also know that the price didn't stay at those higher levels forever. In other words, the sellers at some point became stronger than the buyers, causing the price to go down, aka there was bearish sentiment. So notice how now we have an instant where there was a strong sentiment switch from bullish to bearish, where the final sentiment is bearish. Again, the final sentiment is bearish. Meaning, if I were to ask you, is this a sign of strength or is this a sign of weakness? The candle is green, but the final sentiment is bearish. What would you say and why? Well, since the final sentiment is bearish, this is a sign of weakness. Never mind the colors. It's not about the colors. The wick tells the truth. The wick tells the story. This wick over here is yelling loud and clear, hey, the buyers failed. The sellers are getting in the lead. And therefore, this is a sign of weakness. So what does this mean when it comes to what is likely to happen with the price next? It means that it is very likely that the price is gonna fall. There's no certainty in trading. And this is the reason why I gave it 2 out of 3 arrows when it comes to the probability of the price going down. So whenever you see a Gravestone Doji, don't immediately jump into the conclusion that, okay, 100% the price is gonna fall. Boom, I'm gonna go short, I'm gonna sell. So let's put our Doji knowledge to the test. If I were to ask you, is this candlestick that you see in the middle of the screen a Dragonfly candlestick or is it a long-legged Doji? And why? Really think about it and pause the video if needed. It turns out that some people are gonna say, yep, this thing 100% it's a Dragonfly. It has a very long lower wick, it has a short upper wick compared to the lower wick, and the body is on the top half. So this has to be a Dragonfly. But it turns out that there are other people that are gonna say, yep, this is definitely a long-legged Doji because it has long wicks on both ways, and sure, the body is not that exactly in the center, but it's close enough in the center, so it's a long-legged Doji. Who's right and who's wrong here? It turns out that both are equally right or equally wrong, however you want to see it. Because the truth is that there is no crystal clear line for when one candlestick becomes another. Trading is not an exact science. There is a lot of subjectivity going on in trading, meaning that two different traders can look at the exact same charts and draw completely different conclusions and make completely different trading decisions. And this is the reason why I invite you to do the following. I invite you to try to not memorize candlestick names like flashcards. Try to not memorize the Gravestone names or the Dragonfly or the long-legged. Instead, try to understand the story that each candle shape is telling us. Ask yourself, okay, when I look at this candlestick, never minding the color, paying attention to the wick because I understand that the wick tells the story. Who tried, who failed, and who is in control now? This is what's gonna set you up for success. And I wish someone would have told me this when I started trading. Now, I wanna welcome you to the world of groups of candlesticks. Let's start with a price waterfall. How do we visually recognize the price waterfall in our charts? The price waterfall is a group of candlesticks where you're gonna see 3 or more red, aka bearish candlesticks together, where the spreads are getting wider, meaning as the price is evolving, the rectangles are getting longer and longer. In other words, as price goes down, the bodies become bigger. There are barely any green candles in between, but if you see one tiny green bullish candle in between is okay. It doesn't mean that, like in the example that you see on the screen, that because there is one tiny baby green candlestick, it's no longer a price waterfall. No, it's still a price waterfall. And for those people that like to use visuals to remember things better, it looks like the second half of an arch. So let's see what happened during the move. We know that during the move, the seller stepped in. And we also know that the sellers keep stepping in harder every single time. And we know this because the spreads are widening. The rectangles are becoming longer and longer. And the buyers are barely fighting back, or maybe not even at all. And the only way to see whether the buyers are fighting back during the printing of these candles is by dissecting this group of candlesticks on the faster time frames. So how do we interpret the price waterfall? We note that the sellers are clearly in control and they're gaining more and more control as the candlesticks develop. In other words, there is increasingly bearish sentiment. The price is dropping fast, and usually this is when the market is likely in panic mode. If you want to learn more about fear and greed and panic and how the insiders use this to their advantage, I highly recommend you to take a look at chapter 2, where we learn how the market cycles works and I explain all of the psychology behind it. The link is down below, and I'm also going to leave a card up here left. Now, if I were to ask you, since there is increasingly bearish sentiment, would this be considered a sign of strength or a sign of weakness? And why? Well, since there is increasing bearish sentiment, aka sellers are gaining more and more control, this is a sign of weakness. And what does this mean when it comes to what is likely to happen with the price next? It means that it is very likely that the price is going to continue going down. And I give this 2 out of 3 arrows when it comes to the probabilities of the price going down, because there's no certainty in trading. But overall, it is a sign of weakness, and it is very likely that the price is going to continue falling. Candlestick pattern number 14. Falling price with narrowing spreads. How do we visually recognize this pattern on our charts? You're going to see 3 or more bearish, aka red, candlesticks together, where as the price is falling, the spreads are getting narrower, not wider, but narrower. So the rectangles are getting more and more and more compressed. So as the price goes down, the bodies are becoming smaller. And there are usually no strong green candles in between. But if you see a few green candles in between, that is totally okay. You know, it's not the end of the world. In this specific example, we don't have a tiny green candle in between, but don't be surprised if you do. For those people that like to remember things visually, the falling price and the narrowing spreads pattern looks like the first half of the valley, where as the price is falling, the slope is diminishing. And it often happens after a price waterfall. And that's exactly the example that you see on the screen right here, where the first 3 candlesticks are the price waterfall. Falling price, widening spreads. But then the yellow rectangle is showing falling price and narrowing spreads. And this is what I mean when I say it often appears after a price waterfall. So what happened during the move? We know that during the move, the seller stepped in, but we know that the buyers are actually starting to push back. And how do we know this? Well, because there is something compressing the price up more and more and more as the price is developing. And what would that thing be? That thing would be the buyer stepping in and pushing the price higher, offering resistance to the sellers. This is what causes the narrowing spreads. In other words, the sellers are losing. They're losing momentum. And once again, as with any candlestick and with any group of candlesticks, the only way to see the full fight is to dissect these candles on the faster time frames. How do we interpret this falling price, narrowing spreads pattern? We know that with each candle, the sellers are losing momentum and the buyers are gaining more and more control. In other words, the bearish sentiment is weakening and the bullish sentiment is building. The price is dropping less fast and the market is likely to stop falling soon. So if I were to ask you, given this information, these conclusions that you see on the screen, is this a sign of strength or is this a sign of weakness? And why? Since the price is likely to stop falling soon, this is a sign of strength. And what this means about what is likely to happen with the price next as well, it is very likely that the price is soon going to start going up. And this is exactly what happens in the example on the screen. The price actually started going up. But then once again, I gave this 2 out of 3 arrows when it comes to the probabilities of the price going up because there's no certainty in trading. It doesn't mean that whenever you see falling price, narrowing spreads, that the price is going to skyrocket. No, you have to take multiple factors into consideration. But overall, it is a sign of strength and it is likely that the price is going to start rising. Pattern number 15, rising price, widening spreads. How do we visually recognize this pattern in our charts? You're going to see 3 or more bullish, aka green candlesticks together, where as the price is developing, the spreads are getting wider, so the rectangles are getting longer and longer. In other words, as the price is going up, the bodies become bigger. There are usually no strong red candles in between, but if you see a few weak red candles in between, that is totally fine. It doesn't mean that this pattern becomes invalid because of that. Like, look at the example on the screen. There is a tiny red candle in the middle, or not exactly in the middle, but at the beginning of the pattern. And it doesn't mean that the pattern becomes invalid, not at all. And for those people that like to visually remember things, it looks like the second half of the valley. As the price is developing, it's rising steeper, steeper, and steeper. So what happened during the move? We know that during the move, the buyers stepped in, where the buyers keep stepping in harder every single time. And we know this because the spreads of the candlesticks, so the bodies of the candlesticks are becoming wider and wider. So the sellers are barely fighting back, or maybe not even at all. And the only way to see whether the sellers are pushing back a little bit while this move was happening is to zoom in on these candles by using the faster time frames. How do we interpret this rising price, widening spreads pattern? We know that the buyers are clearly in control and they're gaining more and more control. In other words, there is stronger bullish sentiment. Since there is stronger bullish sentiment, this is a sign of strength. And what this means about what is likely to happen with the price next is it is very likely that the price is going to start rising. I give this 2 out of 3 arrows when it comes to the probabilities of the price going up because there's no certainty in trading. In other words, whenever you see this group of candlesticks, it doesn't mean that the price is going to go to the moon. There are multiple things that you need to take into consideration, but overall, this pattern of rising price and widening spreads is considered a sign of strength. The last and final pattern, rising price, narrowing spreads. What are the visual characteristics of this pattern? You're going to recognize it because you're going to see 3 or more bullish green candlesticks together, where the spreads are getting narrower. In other words, the rectangles are getting more and more compressed. So as the price is going up, the bodies are becoming smaller. There are usually no strong red candles in between. But if you do happen to see a few weak red candles in between, that is totally fine. It doesn't mean that this pattern becomes completely invalid if that happens. And once again, for those visual people, it looks like the first half of the bridge, where as the price is rising, it is rising less and less steep. So what happened during the move? We know that during the move, the buyers stepped in, but the sellers are starting to push back down. And we know that the sellers are starting to push back down because there was something compressing the price from up downwards. And that something would be selling pressure. So we know that the sellers are stepping in harder with every single candlestick, giving the buyers more and more resistance, aka the narrowing spreads. So buyers are losing, they're losing momentum. And we can only see the full fight between the buyers and the sellers by dissecting these candles on the faster timeframes. How do we interpret this rising price narrowing spreads pattern? We know that with each candle, the buyers are losing momentum and that the sellers are gaining more control. So the bullish sentiment is weakening and the bearish sentiment is building. So the price is rising, but it's rising less fast. And this usually means that the market is likely to stop rising soon. So if I were to ask you, if the market is likely to stop rising soon and there is increasing bearish sentiment, is this a sign of strength or is it a sign of weakness? Given all of these conclusions, this is a sign of weakness because the market is very likely to stop rising anytime soon. What does this mean when it comes to what is likely to happen with the price next? It is very likely that the price is gonna start falling soon, or at least go sideways. And that is exactly what happens in the example on the screen. The price actually started to go sideways. It started to consolidate. I give this 2 out of 3 arrows when it comes to the probabilities of the price going down because there's no certainty in trading. It doesn't mean that 100% of the times that you see rising price and narrowing spreads, that the price is for sure gonna go sideways and for sure gonna go down. Overall, this is considered a sign of weakness and it is very likely that the price is gonna go sideways and maybe even fall. Congratulations, guys, because you have taken your first concrete steps to become an actual, real, successful trader. You now understand the 16 most important candlesticks and candlestick patterns that you're going to see on any chart, on any time frame, and on any instrument. And this is what's going to set you up for success. Try to not memorize these names. This is why I gave you those visual reminders that it looks like a valley, it looks like a bridge, because this is not about memorization. It's really about understanding. And now, this is you. You're holding the flag of success. So really, give yourself a pat on the shoulder because you're doing something that many people don't have the courage to do. Now, if you're serious about this, and I know you are, here's one more thing that I'd love for you to do. When this video ends, open up a chart. Could be any chart. And start spotting the patterns that we covered. Some of you might be wondering, why would I do that? I just watched this video and this is enough. Because that's how we turn this from something we just watched into something we own. Because guys, there is a huge difference between accumulating theory versus applying that theory. Wisdom is not the accumulation of theory. The wisdom comes from knowing how to apply that theory and getting the same satisfactory results voluntarily over and over again. That is what mastery is. That is wisdom. And that's exactly the outcome that I want for you, which is why I advise you, open up a chart, have some fun. You know, you don't have to place any trade yet, but try to see the Gravestone Doji, try to see the Dragonfly Doji, try to see the price waterfall, for example. You're gonna be amazed by how the charts are suddenly gonna start making much more sense. To prepare you for the next session. So far in this course, we have learned that all markets are at some point manipulated. And this is something that we covered in chapter 2, where we looked at the market cycle and we learned how the insiders use the emotions of fear and greed to create the famous market cycles. And why this is important to know is because this means 2 things. It means that since the insiders are involved, that some price movement is legit, is not manipulated by the insiders, and that other price movements are false because they are manipulated by the insiders. So the big question is, how do we know which is which? And the answer is, you might have guessed it, by looking at volume. Because volume is the one thing that the insiders can hide the least. And this is the reason that in the next session, we're gonna learn all we need to know about volume. We're gonna answer questions such as, what exactly is volume? What does each volume bar actually tell us? How can we tell if volume is high, low, or just normal? What does rising or falling volume on its own mean? And how can we start using volume when looking at our charts? And of course, I'm gonna give you real life examples so that this actually clicks. Thank you so much for investing your time, energy, and attention in your own education. And remember, enjoy the process. Unless you've got other plans.